So my name's Mark Blackwood. I'm from Ironwood Finance. I focus on investors in the personal name and in SMSF, which has become a big thing lately. I've got Matt Kidd with me today. He's from One Haven Property in Melbourne. Um, Maybe you want to introduce yourself, Matt, and tell me what you do.
Yeah, thanks, Mark. And g'day everybody who's watching this. So my background is wealth creation using property. So I've been financial planning for about 25 years, and have always had property as part of the investment strategies for my clients. And pretty much 90% of them have all had a self-managed super fund and a property in their super fund. Because for me, it basically is probably one of the most sound strategies when it comes to investment. So yeah, so my background is financial planning, but on top of that, we're really good boutique property brokers, as you said, based in Melbourne. I'm based in Sydney. I look after pretty much the whole eastern seaboard, and our goal is to basically put clients into investment properties that suit their objectives and goals.
You cover pretty much the whole of Australia, yeah?
Yeah, we do. I mean, we're very market driven, so we don't. So whilst we cover the whole of Australia, it doesn't mean we'll invest in the whole of Australia. So we'll look at any particular market any time and decide whether that is the right time to invest in that market or it's the wrong time. So, for example, Perth and Adelaide at the moment too expensive, so we're not really focusing on that. Our main focus at the moment is Melbourne and Brisbane.
Right. So today we wanted to talk about SMSF and how that works and lending through your SMSF, because obviously that's become a big thing now that borrowing capacity and people's personal names is getting a bit tight for most people.
Yeah.
So everyone's looking at moving their super into an SMSF to do it there. The rules as a broker, the rules are different there. It doesn't look at your personal circumstances. It only looks at your super and your actual income. It doesn't look at your assets and liabilities. If you've got credit cards and that sort of thing. So how does it differ when you're looking at generally for a property in super rather than in your personal name?
Yeah. So the main difference is if you're investing in your own name now, you're basically getting a tax benefit now. You're getting a performance benefit now, whereas in your super you're getting a future benefit. So because super funds only pay 15% tax, so you're only going to get 15% depreciation. But the benefit is when you retire and at pension age, you can sell those properties capital gains tax free, or if you decide to retain those properties, the income you earn is income tax free. So so we're investing for a future benefit as opposed to a benefit now.
Right. So for the very amateur or the people who haven't really done much research, what is an SMSF exactly?
Okay. So SMSF stands for self-managed super fund, but I think there's a lot of people probably read a bit too much into that. Self-managed really means that it's just under your control, and you choose the investment. The accountant and the auditor will do all the work for you, so you don't have to sit down and do hours worth of paperwork every year. But self-managed basically means you choose it. Interestingly, self-managed super was first brought on back in the early 90s, in 91 when superannuation first became compulsory in Australia. It was recognised as at only 3%. It was recognised there was certainly older Australians who were in professions that they weren't going to be able to get enough money to super retire, so they were allowed them to set up their own super fund and actually buy their property in conjunction with in a trust for them to rent that property off them, and that's where super funds actually came from. So they were actually originally made for property. Times have changed and moved on now, and it's a lot easier and cheaper to set up a super fund and borrow money and buy a property. Now, obviously, this is general advice, but comparatively speaking, if you think about you've got an amount in super and you can borrow another amount from the bank, and you invest in a investment property, the performance on that property is based on the gross value, not the net value. So you get the leverage and the uplift from that loan component. So it's a very unique situation we have in Australia where you can set up a super fund and it is allowed to borrow money and buy a property, and you benefit from that leverage later on when you retire, as opposed to leaving it in another investment managed funds or shares or whatever without the leverage. And we all know that leverage over a period of time creates more wealth. So that for me is why it's a very good strategy.
So yeah, when we're focusing on the property side of it, obviously when you go and buy shares and set out an SMSF up, buy shares or whatever, you can do whatever you like, really. You don't need any minimum amount. When you're buying a property, you do sort of need to consider how much you're going to have in that fund. You hear a lot around the internet, and you see if you Google, it's 200,000 is the number you normally hear. What are your suggestions on that sort of minimum balance you expect for your super fund these days? Considering prices have jumped quite a lot in the last couple of years.
Probably like to see somewhere between 250 and 300, to be honest, because what we don't want to do is put the super fund under pressure. Because the super fund doesn't get a big tax benefit up front, there's always going to be a shortfall between what the super fund has to fund before it claims any tax back. So we want to make sure that those contributions from the members of the super fund comfortably cover that shortfall and not chew up every dollar that comes in. Someone loses their job or whatever, and that means those contributions aren't going to be able to cover the cost of that property, and we don't want that. So the more money we can have up front, the better. That means we have a lower LVR, and we want to do principal and interest repayments. We want to pay that loan down as opposed to interest only in your own name. We want that debt gone by the time you retire. So the more we can actually put in capital we can put into that property initially, the better off we're going to be.
So we've sort of touched on it already, but why would someone choose an SMSF rather than a retail industry fund?
Yeah. So again, this is general advice only. That if you were to have, say, let's just say for argument's sake, $300,000 in shares and $300,000 cash, so we have $300,000 in shares. On average, property doubles every 10 years in Australia. Historically, we can go back 100 years. That's a fact. Now, and shares double about every 7. But let's just make it easy from a mathematical point of view. Let's just say shares double every 10 years as well. So if we've got $300,000 sitting in shares, in 10 years' time, it's worth $600,000. In 20 years' time, it's worth 1.2. That's not taking into consideration dividend reinvestment or anything like that. I'm just going simple maths. So if we take that $300,000 and we borrow $500,000 and we buy an $800,000 property, and that doubles in 10 years, goes to 1.6, and that doubles again, we're talking about 3.2. So we're talking 3.2 versus 1.2, a $2 million differential in what the value of that super fund, because we can't do that leverage that we can in the property that in the shares. So just on that alone, that calculation says you're $2 million better off when you retire because you had more money to invest because we got to borrow that money from the bank. And so, and we sell that capital gains tax free. So that $2 million becomes $2 million in real money because we would have paid off that loan in the meantime. So there's no debt left. So, it's not hard to work out the difference between, the performance because we've got extra money. If you've got, the more you've got to invest, the more it's going to perform.
So essentially you're saying it's the leverage, the lending we can get on that property is the main contributor to the excess growth over shares.
Yeah, and the good thing about that, with the property, we don't have the same volatility in property that we do in shares. So if we go back before the GFC, for those of us who are old enough to remember what happened, that we had a lot of shares and managed funds that had leverage, and that's what caused the GFC. There was a lot of debt in shares and managed funds. Now, after the GFC, that pretty much all got wiped out. We actually used to be able to leverage shares. I myself had a share portfolio that had a loan attached to it because we were allowed to leverage off that. So if you're comparing one versus the other, shares were probably a little bit better because we had the franking credits and dividend the DRPs and all that stuff. But you take that leverage away and they're completely different investments all of a sudden. And so the property now has a significant advantage because it has the leverage.
So I guess when you're buying shares, you can buy a little bit of this and a little bit of that, and have 20 stocks or shares in like with 100 grand or whatever. So you sort of minimize your risk on one. So when you're buying a property, obviously most people are looking at one, maybe two, possibly three properties in super
Yeah,
in the short to medium term. So yeah, I guess the big worry would be making sure you pick the right property. Yeah.
Yeah, look, absolutely, 100%. But it's the same with any investment, Mark. We've got to do all our research. We've got to get advice. We've got to take as much advice as we can, do as much research as possible, and stick to fundamentals. So if we look at fundamentals, we stick to our capital cities, and we stick to 20Ks within the capital city. But look, my theory is be boring. When you invest, be boring. Boring is good. Same with shares. You can buy the globe in 5 trades. You can buy 5 indices around the world with 5 clicks, cost you $100, and sit on that for 20 years. You're going to have a very good investment. Properties are the same. You do all your research, make sure you're getting the right advice and you're buying the right property to suit your budget, and then we sit on it, because time is the essence. You've got to all investments go through different cycles, and the longer we hold that investment, the more cycles we get to go through. So it will be worth more at the end of the day if we hold on to those investments for the long term. Property is absolutely no different. The shares have an advantage. Obviously, they've got liquidity. So if you need liquidity, you can sell your shares cheaply and got the cash. Can't do that with property. So again, it comes down to getting the right advice and having the right strategy moving forward.
Obviously, people with a bit more knowledge and background in the industry or investing in general will be able to do this a bit more on their own. But a lot of people who come to it just wanting to set up their future, not really having time to do anything.
Yeah.
I guess I see a lot as a broker, people coming to max out the loan, so 80% loan, whatever max they can get. Even now, some lenders do 90%, which I find crazy. But there are people that just want the leverage, which is a bit dangerous in super. But by the sounds of it, you're sort of saying, in general, for the average person, your goal is sort of just to set and forget, buy the property and hold it until retirement.
Yeah. So, it depends what the strategy is. I mean, if it is to hold one property, you'd probably put as much capital into that one as possible and have a very low LVR. So that shortfall it's almost the opposite as when you buy it in your own name. You want more capital, you're more money into the super fund investment than borrowed, because we want to make sure that shortfall doesn't get out of control because of the lack of depreciation that the super fund will get. But if the strategy is to buy another property, then we want to make sure that we don't tie up all our capital in that one investment, because as you and I discussed previously, we can't get an equity loan out of that existing property under the rules and then go buy another property. So we've got to allow that we've built up more cash to go buy another property, or we've got to leave some cash left over, so if we've got some capital to buy that next property.
That's a good point. So a lot of investors come and they think they can buy a property, get a couple $100,000 in growth, and then release some equity to go and build that loan structure and keep buying another property using the equity over and over, which obviously is not allowed in super. It's the most basic loan you can get. There's now guidance to say you pretty much can't use offset accounts either. So if you put extra money into the home loan, into the SMSF property loan, then it's gone. Can't redraw it out. You can't release equity. You can just do a basic refinance, dollar for dollar, for fees, to get a better rate. So I guess there's a lot of differences there. If I've gone, okay, so if you wanted to buy a second one, like you said, we'd have to sort of prepare for that up front, and it's better to have, I guess, a financial planner for that sort of thing.
Yeah,
but if you don't, at least give you numbers, but we can't really give advice.
No, exactly. So you want to seek the advice of a financial planner, because they'll take into consideration a lot of other factors that will allow you to put a plan together. But as you just said, if the plan is to have more than one property, then we've got to have a plan. Not having a plan is not a plan. It's not a strategy. So if going in property is great, don't get me wrong, but if there is a strategy to own more than one property, then we've got a plan for it. And a lot of people don't understand too is that the maximum contribution the concessional contribution, concessional means you get a deduction for, or your employer gets a deduction for, has now gone up to $30,000 for this financial year. So per person, so per
That's
couple.
just your super come through your pay slip generally for most people.
Yeah, or if you're self-employed, there's your contribution go up 30. So there's two, husband and wife, they can contribute 60,000. Now we can go back retrospectively up 7 years. If you haven't been contributing the max and say you're earning more now you might say, oh, we've only got 200,000 now super, but your accountant can very easily find out how much more you can contribute for the both of you to get yourself up to what was 27,000, it's now 30, and so on. So you might find there's potentially another $100,000 you can contribute to super concessionally and get a deduction for, and you might have that access to that cash elsewhere, and you can actually put that into your super and use that to buy the next property. So again, that's where a really good plan will cover off all that, so we know where that money's coming for the next property.
All right. So we've decided we're going to do an SMSF. We're thinking about property, but what are the costs sort of for setting up one of these things?
Yeah, look, I mean, if you're setting up a SMSF to buy property, there's some extra costs. So a basic SMSF is around about sort of $3,000, etc. Plus GST. But when you have setting up super fund for property, you need what we call a bear trust. Now, bear as in bear, the cupboard is bare, there's nothing else in it, and we've got to have a corporate trustee sitting over that trust. So there's more costs in order to set that up. So I always say to clients, allow $5,000 to set the whole thing up plus GST, because we've got two companies, we've got two trusts, we've got two ABNs, we've got registrations, we've got rollovers. There's a lot of work to be done. But the good news is, once the rollovers have been done into the super fund will pay you back the money that you put out of pocket to set the super fund up, because it's people have to look at the super fund, I always say, as the third person in the room. That person, the super fund, is responsible for all its own costs. So if you've paid for something, the super fund has to pay you back. So it actually won't cost you anything, it'll cost your super. The other thing too, Mark, is a lot of people will think, well, we've got annual fees, we've got to pay for our super fund, and that is correct. What they don't realise is they're paying fees already, and they just don't know what they're paying. I'd say 99% of Australians have never gone to their statements and actually calculated what their super fund is charging. Yeah.
There's a lot of negatives coming through that statement.
Yeah, absolutely. And I reckon they'll work it out and go, actually, it's almost the same as what I pay to run my super fund. So it's not an additional cost, it's just a change of cost. It might cost a little bit more once you buy the property because there's an audit involved, but you've got something more complicated, right? You've got a property, whereas your other super fund didn't have a property. So it's all relative. But I can tell you right now that the fees you're paying in whatever industry fund or a retail fund is not going to be too far away from what you'd pay for a self-managed super fund.
I guess that's another reason for having a minimum amount available. So if you start a super fund with 100 grand, the fees are going to be a lot more substantial.
Yeah, you wouldn't. You just, the financial
fee, right? You have a set fee for an accountant and an auditor. That's the same whether you got $10 or $10 million in the fund.
Correct.
So
correct.
Yeah.
The more you have in the fund, obviously, it's because audit and accounting is time-based. So the more you have in there, the more it's going to cost you, but it's not going to go skyrocketing. It's going to be linear. With some funds are based on the value, like some retail funds, your fees are based on the value of the fund. So there'll be a calculation. So yeah, you're right. If you with $100,000, that's why you wouldn't set up a super fund, because it just wouldn't make any sense. You're paying 5% of the value of the super fund to set it up, and another 3% for the annual fees. It wouldn't make any sense. That's why you need the capital in there to make it worth it. I think there's a line in the sand of calculation that once you get to about $400,000 in your retail super, it's going to cost you more to be in a retail fund than it would be in your self-managed super fund.
Right. So with the so that's costs obviously, but what are the benefits? We've gone through a little bit of the benefits, a couple of tax benefits as well. What are the main ones?
Yeah, for me it's about taking control of your money. I mean, I think most people in Australia don't recognise or actually understand that that's their money. Yes, someone else is investing it, but it's your money to retire on. So I say take control and have a say. Now you can still have a say, I guess, in a lot of funds you choose, which whether it's balanced or high growth or it's non-forestry or non-mining or whatever, there is some choice. But when it's in your super fund, it's all your choice. And the great thing is now you can have up to 6 members of a super fund. So you can have mum, dad, brother, sister, uncle, auntie. You can create your own property portfolio and share portfolio in your own super fund, and you can have up to 6 members doing that. So you talk about diluting the cost of a fund. If you've got double the amount of members but the same one fee, well then that fee's just been halved, hasn't it? So it's a great way to reduce the cost of super, but also increase, because the more we have in there means we can buy another property, we have more capital, and that means we have more leverage, and that means we get more performance down the track.
Right. So yeah, and it sounded a bit confusing before. You're talking about 2 trusts, 2 everything.
Yep.
That sort of thing. But basically, the way I see it, when we see it set up, and I get the documents as a broker, basically it's just a bank account, right? Before you
Correct.
invest in anything, the super fund is just a bank account with the super fund's name on it that you have control of.
Yep.
Just like you do with your own bank account. However, it's audited. So if you do buy a coffee, those funds, you are non-compliant. So that's where you get into trouble.
Yeah, but your accountant will control all that. You'll have an accountant. They'll control what happens. They appoint the auditor. The auditor will be independent. So again, that whole, I think people do get a bit nervous about the whole compliance issue, but in reality, they're not doing it. So as you said, if that super fund has a bank account and something's bought in that bank account, you've just got to be thinking that there's an auditor going to be going, hang on, there was a coffee bought in that. I need to know more about that coffee. Or if it was an expense, I need to know more about that expense. And look, the auditor is not the big bad wolf. Auditors are pretty good. They just want to make sure that everything's being done appropriately. Because at the end of the day, it's your money for your retirement, and that's all super is for that. But that's the whole emphasis of having super is for you to actually be comfortable in retirement. So that's all the auditors making sure that you're abiding by that.
Yeah. So I'm like, obviously I'm a broker, you're in property, so we're a bit geared towards that side of it, and a lot of people that are listening in will want to know more around probably the property side of it is. So maybe just in the last couple of minutes, just maybe give us some sort of pointers of what you look at when you're at the average client you see. What are you sort of aiming for? Obviously, they've got goals as well, but in general, what do you see? What are people wanting to buy?
Yeah, look, I mean, first thing, there's a couple of things properties super funds can and can't buy. They can't, if they hopefully most people have heard of house and land. We can't do house and land if it's dual contract, and dual contract means buying the land and having a construction loan, because super funds aren't allowed to develop it, and that's deemed as a development. So we've got to knock that out straight away. Again, it comes down to budget, and the goal is to find a single part contract investment, be it townhouse or a single part house and land, that generates good yield and good growth. And so generally speaking, that's in the major capital cities. And so because capital cities have immigration, and immigration is the number one driver of property prices. We don't do regional, we don't advise on doing regional, because then you are relying on industry, primary, tourism and mining. And if one of those industries doesn't perform very well in that particular area, your property won't perform well. So, for good long-term performance, capital city and single part contract. But again, we also recommend new. Buying new property means it's like buying a new car. You get new warranties, you get new everything. Nothing's, if something goes wrong, it gets fixed, it gets replaced, and it's new. So you're going to get the best rent and all that stuff. So we certainly recommend new property.
So can you do all the tax benefits through your super as well, like depreciation and those sorts of things?
Yeah, you can. But super funds only pay 15% tax, so your depreciation's not going to be huge. It's going to be you'll get 15% basically, and then
it's just more important to get the right property still.
Correct. Yeah, it's not a tax play. I mean, yes, it's better than nothing getting 15%, but that's not why we're doing it. We're doing it to get a long-term tax play. And that's what I said before, that shortfall. Because if you and I buy our own names, we get that lovely big depreciation schedule, and we've got to fund it before tax, but after tax we get a refund from the tax man. Hopefully, that doesn't happen in super, because we're only getting 15% depreciation. So we're definitely going to have to fund a shortfall, unless we're putting a lot of capital into that. We have less than a 50% LVR, well then we're probably not going to have a shortfall, or if we are, it's going to be very, very small. But if you're going 70-80% LVR, you will have a shortfall, and we need to make sure that's covered, because we don't have that big depreciation.
So we look at that as well. I've got a mix of clients. I've got clients with 50% LVRs all the way up to 80%, depending on how conservative they are, or whether they use a financial planner, who are generally more conservative anyway, or whether they've got a future goal of buying another property fairly quickly in their super. So obviously they're going to gear up a little bit more.
Yes.
But there's always a consideration that how likely is it that their income from their employment is going to keep going? Because that may have to pop up it a little bit while you're out of employment, maybe for a 6-month period or 3-month period.
Yeah, we've got to stress test it, and that's the thing. So I touched on it before, that we don't want a super fund to be completely beholden to this property, that every cent goes into it. We need that. we need that flexibility. We need that buffer. And so if someone does lose their job, there's still money there that's going to comfortably pay the shortfall for at least a year or two, and that's why we have that 250 to 300,000 minimum, because it means we're going to have a buffer, and that's very, very important, and that's where a good financial planner will guide them, and myself as well. I mean, I will, if I had a client come to me and we crunched the numbers and it just wasn't there, yes, they could get the loan, but there's no buffer, I would be advising them against buying that property.
All right, mate. Let's wrap that up.
Yep.
We've probably gone a bit too long already.
That's all right.
Thanks for joining me today. So, Matt Kidd from One Haven. You can look him up on Google if you're looking at property at all. And I'll talk to you soon, mate.
Thanks very much. Thanks for